Good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers around the house. Welcome to this week's Mortgage Minute. Glad to be back live after we had a couple of recorded sessions these last 2 weeks. I want to thank Christy Glenn with Palm Desert Insurance, as well as Brenda Devlin with Brenda Devlin Real Estate for coming on the show and providing us some very good and helpful information about both the insurance and real estate market. And of course, the big news, the good news now this week, as of today for sure, is the government shutdown is over. Wow, that was 40 days of torture, but glad things are getting back up and running. So that's got to be good news for everyone. And I'll just, of course, leave it at that. And of course, this week, we've had Veterans Day on Tuesday, a great opportunity to thank and support our veterans, both past as well as the fallen. And so that's part of why this week on our show, we're going to be talking about VA home loans. So we'll get to that in just a minute. In the meantime, we always like to start with giving you an idea of where mortgage rates are. So we're going to pull up our rate grid from our website. And it's going to be more of the same in terms of our rate grid. Rates pretty much have stayed right where they've been at now for several weeks. Haven't really moved much at all. And of course, you can see there, conforming loans continue to be right below 6%, including the buy downs, 2-1s and 3-2-1s. FHA and VA, again, still in the mid fives. And then we still have the opportunity to provide some jumbo financing right around 6. Or what I think is a great option for jumbo loans is that 7-1 ARM, where you can see that rate of 5 and 5/8. So that's really very good in terms of a rate for a jumbo loan. And of course, equity loans, HELOCs, and HE loans continue to be a very good deal, in particular the HE loans. In fact, we're about to close a HE loan from one of our customers today, where he's going to get a 10-year fixed equity loan, fixed rate for 10 years at 6.675. That's a terrific rate for a second mortgage. So keep that in mind for any of you homeowners that have been contemplating getting secondary financing, because you don't want to touch that very low rate first mortgage. And again, at the very bottom of our rate grid, there's that about mortgage rates. If you're new to the show or haven't looked, click that on, and I give you a little bit of a primer as to what is behind how mortgage rates are set. I think it's pretty good information you'll find valuable. We're going to pull up, Jeff's going to pull up our 10-year bond chart. This goes back for the last 5 days. And you can see it's been a little bit choppy, but still in a very good and a pretty narrow range, right around 405 to, of course, you can see today a little bit of an uptick to 412. So, of course, Jeff will point out there was that Wednesday dip that he likes to see. And of course, it didn't last long going into the end of the day on Wednesday. And then early this morning, we were down closer to 405. But now back up to 412. But overall, that's a very narrow range. And so that's, again, I call it good news, because at least we're not seeing things skyrocket. But the other thing this shows is, we had that Fed funds rate reduction here just a week or so ago, 0.25%. And at the time, right before that announcement, the 10-year bond was right around 4%. Now it's 412. So again, another example how everyone gets all ramped up and excited about the Fed's about to lower rates. And what happens is on the mortgage rate side, they tend to drop or trend lower up to the announcement. And then once the announcement occurs, we tend to see a rise in yields. And that's what's happened again. We're actually about an 1/8% higher in mortgage rates than just before the recent Fed announcement where they reduced the Fed funds rate 0.25%. So what's going on to move the markets? Well, interesting, because it's another light week for economic data points. Why? Because the government's been shut down. And so as I put here on the screen, no data is no bueno. Data points have been delayed again this week. And I provide you there a list of the data points that are scheduled for this week, but that we don't have data for. And so as a consequence, rates really have been kind of just fixed in this narrow range. And the initial jobless claims, CPI, that's inflation at a retail level, U.S. retail sales, and then the PPI, producer price index, which is actually scheduled for tomorrow. That's inflation at a wholesale level. That's not expected to be announced because, again, of the government shutdown. So all of those are important data points that we just don't have data for. And of course, that makes it more difficult for financial market participants to react to news that we just don't have. And so as a consequence, what's happening? Rates are basically just treading water. And again, I actually consider that better news than not, because sometimes the market can overreact to data points where they think it's not good news. So again, just more of the same. It maybe gets a little boring, but at least we kind of have a fairly good degree of certainty as to where mortgage rates are and where there have been. The other thing, though, that has really been big news this week, I think almost overly so, is the 50-year mortgage proposal that came out from our federal government here this week. And of course, you see on the slide there, I call it, is it potential? Does it have potential, or is it hype? So let me give you a little bit, at least my take on that whole debate, because I've seen arguments about this proposal on both sides. First of all, let me give you, it's a little bit of irony that I'm going to provide you through some historical context. You may remember after the Great Recession, back in those days, we had a legislation called Dodd-Frank. Now, out of Dodd-Frank came the creation of the Consumer Financial Protection Bureau. And with that, there was a brand new landscape in terms of mortgage guidelines, the methodology by which mortgage borrowers would be qualified to borrow funds to purchase a home, and the whole new concept called ATR, ability to repay, came to be, where we had to extensively document a borrower's income, determine that they actually could qualify for the loan amount and payments that were resulting from that loan amount based on calculating their debt ratio and their qualifying income. Now, as part of that new regulatory landscape, there was a new set of loan categories. Of course, conforming loans, which has always been sort of the predominant category to get the best type of financing, best rates. But there was a new category that rose out of all this called non-QM, non-qualified mortgage. And within that bucket, one of the things that occurred is we had to now start providing a borrower with a disclosure called anti-steering, where what it was intended to show is that we were giving a borrower a full picture, a full range of loan options for them with a rate range, lowest rates available to highest rate available based on no cost or with cost. And in terms of that disclosure, one of the things that reflected is what was the best kind of rate you could get for a loan with non-risky or no risky features. Well, guess what one of those risky features is? 40-year amortization. 40-year loans have been around for a while, but yet out of the Consumer Financial Protection Bureau came the non-QM mortgage product, and in that bucket is 40-year loans. 40-year loans are deemed too risky to be sold to Fannie Mae and Freddie Mac. So right now, today, even given this new proposal for a 50-year mortgage, Fannie and Freddie do not buy 40-year mortgages because they're deemed too risky. So why in the world would the federal government now propose a 50-year mortgage? That's the irony of it, because word is that this proposal came from Bill Pulte, the current head of the FHFA, that's the Federal Housing Finance Agency, who oversees Fannie Mae and Freddie Mac. So why would it that the head of the FHFA, who currently considers a 40-year mortgage term to be risky and therefore not eligible for purchase by Fannie Mae and Freddie Mac, why would this person now propose a 50-year mortgage? So the point there is, even if this idea gains some momentum and becomes something that is going to be seriously considered by the federal regulators, there would have to be a change in the current rules to allow the 50-year mortgage term to be eligible for conforming loans. That's what would need to be done in order to really put some teeth into this proposal in terms of providing more affordability in terms of mortgage terms. But here's the thing, some things that you need to realize, even if this idea gains some traction. Number one is, if you're going to have a 50-year term, the time value of money says the rate's going to have to be higher than a 30-year term. That's just fundamental econ, right? In fact, it's already the case. If you want a 40-year loan, which I can provide you, any lender can provide you who does non-QM loans, those are going to have a higher rate than a conforming Fannie Mae and Freddie Mac loan. And a higher rate, of course, mutes or somewhat offsets the benefit of that longer repayment term because of the higher rate. So then if you, by extension, take it out even another 10 years to 50 years, the rate is going to have to be higher still. Like right now, the difference in rate between a 30-year loan and a 40-year loan is probably in the range of about 1/4 to 3/8%. Well, if you're going to then extend the loan term out another 10 years to 50 years, that's 600 months. Guess what? The rate's going to be higher still, probably another 3/8 to 0.5%. So then when you consider a conforming 30-year fix, as you saw in our rate grid, we can offer you $5.99. Well, a 50-year loan probably is going to be at 6 3/4, probably at a minimum. And as a consequence, yeah, sure, that longer repayment term lowers the payment, but then that higher rate raises the payment. So the net benefit to the borrower isn't going to be that significant. On some loan amounts, it could end up being nothing more than maybe $80 a month. That can help, certainly. It's better than nothing, right? But at the same time, is that going to make a huge difference in terms of affordability for most borrowers? Probably not. And to the extent that this loan program, this loan term idea gains traction, and if it does attract more borrowers, it could actually exacerbate the other part of the spectrum, which is home prices. If this proposal creates enough interest that we have more borrowers stepping up to try to buy a home with this particular alternative, that's higher demand for housing. We already have a short supply of housing. That could put price pressure on the existing housing stock, which could then further undermine the benefit of this longer term in terms of mortgage payment, because if you've got a higher price, that means a higher loan amount. And again, that's going to mute some of the benefit of this longer term. And then the last thing I'll mention in terms of the risk quotient with this idea, remember, a 50-year loan, of course, means a much greater percentage of your initial payments are interest, almost all interest. So the amount of principal reduction you're going to achieve with this 50-year loan is going to be very, very small in the first several years. So what that means is you're building equity at a much slower pace, which means you're building wealth at a much slower pace. And then what if we have another 2008 scenario? Well, if you're on one of these mortgages, and even if you've had it for 5, 6, 8 years or so, maybe 10 years, the amount of equity buildup or creation that has occurred in that relatively short period of time out of that total 50 years is not going to be that significant, and lays you to be open to and at risk of going underwater in value if we have any kind of significant market downturns in terms of home prices. So when you consider all of that, is it a tool? Will it have some benefit? Yeah, somewhat. I would argue pretty limited. And in a lot of ways, I don't think is really going to achieve the results that some proponents are suggesting. And of course, there's the other big argument. Well, you're going to pay a lot more interest over a 50-year term than a 30-year term. Yes, that's true. The numbers do say that. They show that. But here's the reality. Most of us don't pay out a mortgage to term. That's already true on a 30-year loan. That's certainly going to be true on a 50-year loan. So in terms of evaluating if this product is good or bad, don't get too much caught up in how much interest are you going to pay over 50 years, because some people do that as how much interest are they paying over 30 years. I don't think that's the best analysis, because most of us, a majority of us, are never going to pay out their mortgage to term anyway. They're going to sell the house before the term is ending, or they're going to most likely refi if rates fall. So that's probably lower on the totem pole in terms of evaluating this proposal. So that's my take on it. It's good. I guess what we'll call clickbait. It's definitely generating a lot of interest, a lot of debate in the markets and in the media in general. But to what extent will this become a major part of mortgage offerings in the U.S. mortgage industry? I am not convinced it's going to be a big factor. So we'll see how it plays out. So again, as Jeff just put on there, don't forget on financial markets, they respond with reptilian-like minds to stimuli. On rates, they're going to be higher for longer. And of course, with the lack of economic data, we haven't been able to see the markets react with these reptilian-like minds because we haven't had the data to react to. So hopefully that's going to change very quickly. Who knows? Maybe by next week or the week after, we'll get back to normalcy in terms of data points, and then we'll have a better idea of how to read the market going forward. So with that, I'm going to go ahead and go into what is the major part of our show today. And again, this is based on considering the recent Tuesday Veterans Day holiday as the backdrop for what I want to talk about today, which is VA loans. So here's what we're going to get into. But by the way, I'm getting it a little bit famous for dad jokes. So given that we had Veterans Day this week, here's one for you to consider. Why is it that the military plants trees every year? Think about that. Why is it that the military plants trees every year? It's because they want to grow the infantry. So there you go. There's my Veterans Day dad joke for your enjoyment. And with that, let's go ahead and jump into the presentation that I have prepared for you today. Now, this presentation is one that I actually just did with the Greater Palm Springs Realtors. And so it is geared toward realtors as the audience, which we do have some realtors in our audience. But I think this is good information for everyone, those who are already own a home, or maybe you're considering buying a home and you might be a veteran with the VA home loan entitlement, or you may know someone who is a veteran who might want to consider using their VA entitlement to buy a home. So understand that this program, this presentation is for all of those folks. So let's go ahead and get started. First of all, the historical perspective on the program. The VA home loan program, the benefit, was created in 1944 through the GI Bill. And the idea, of course, was to help reintegrate World War II veterans into civilian life. The idea was to expand home ownership for those who had served by reducing the barriers to get the financing to buy their home after they came back from the war. And of course, the main feature of the VA home loan program is the idea that you can get financing with little or actually no down payment, zero down payment. Plus the fact that the VA home loan program generally offers better rates than conventional financing. Now, over the decades since World War II, the program expanded to cover more service eras. That's not a typo, eras. That means like after World War II, we had the Korean War veterans, then we had the Vietnam veterans, and then more recently, of course, Iraq and Afghanistan. So with those additional eras, we had more folks in the military serving and who came out of the military who are now eligible for the VA home loan benefit. And one of the things not very well known, the VA home loan benefit is also available for those in the National Guard or reserves. And also any surviving spouses of veterans can be eligible for the VA home loan program. So with that, let's go to the next slide. And you can see here the eligibility criteria for a VA borrower. They do have to meet service, discharge, and entitlement requirements, including veterans who serve their required active duty days. And that does vary depending on which era we're talking about, World War II, Korean War, Vietnam War, and so forth. Active duty members are eligible, typically those who have been active for 90 days of continuous service or more. And then again, I mentioned National Guard and Reserve members. Generally, 6 years of service is required, or if you've been activated for qualifying duty. And then again, certain surviving spouses of fallen veteran service members are eligible or can be eligible for VA home loan benefit, including no down payment. Now, we can establish an eligibility for a veteran by obtaining what's called a COE, a certificate of eligibility. Now, in the old days, way back 40 years ago, when I was still in this, when I first got in this business, that could be a little bit of a challenge to get that certificate of eligibility. A lot of steps involved. It took some time and so forth. We had to get your DD-214, that's your discharge document. I can remember the days when we had to go down to the VA on that big tall building on Wilshire Boulevard in LA, right off the 405 freeway. Well, those days are all gone. It's pretty much been automated. For a veteran borrower or a potential veteran borrower, I basically just need your year born and your social security number, and we can go into the Department of Veteran Affairs system and put that data in and pull up immediately if you have eligibility for this certificate or not. And it'll tell us if you have full entitlement or partial entitlement or no entitlement. So let's go ahead and go to the next screen. And with that, I want to point out a couple of things. While the VA loan program is incredibly strong benefit, it's one of the very best home loan programs out there. The amount of utilization of this benefit is crazy low. Only 15 to 20% of eligible veterans have used it. And you got to scratch your head a little bit. How could that be? A benefit that is so important and beneficial to those who have served is so underutilized. Well, it comes into a variety of factors or reasons, and basically 4 different buckets: awareness, perception, education, and competitiveness. So let's continue on to the next screen. I can give you a little more detail on that. Number 1, lack of awareness. Many veterans simply don't realize they're eligible, especially those who are in the Guard or were in the Guard and reserve members who served during non-war periods. A lot of those folks don't realize they're eligible for this benefit. Also, some believe that VA loans are a one-time benefit and not reusable. Not reusable. That is not correct, and we'll get into that in a little bit. Others don't know they can buy again after a prior VA loan, or even if they have 2 VA loans at once if entitlement allows. That can be done. Again, many potential veteran borrowers are not aware of that. All right, number 2, next screen. Misconceptions about VA loans. There are persistent myths among both borrowers and agents, such as VA loans take too long. Sellers have to pay extra fees. VA appraisals always come in low. But these are outdated perceptions. These outdated perceptions often cause realtors or their sellers to steer veterans toward conventional financing, even when, and this is pretty much true all the time, the VA home loan terms are going to be better than that conventional loan they're being steered to. It's really a bit of a shame. And by the way, in particular, this VA loans take too long to close. That is really, really outdated thinking. Yes, years ago, decades ago, again, I was in the business back then. Yes, VA loans could take a long time because a lot of the front-end origination process, including the underwriting of VA loans, was in many cases handled by the Department of Veteran Affairs. Back then it was called the Veterans Administration. That agency was more directly involved in the front-end origination and underwriting of some of these loans. That's all gone now. VA loans are now processed, originated, processed, and underwritten by lenders. The Department of Veterans Affairs, as the agency is now called, they're not involved in the front-end origination of these loans. This is why during this last month and a half of the government shutdown, I saw a few news article headlines talking about borrowers who were getting FHA and VA loans were going to be subjected to longer processing times. Well, frankly, folks, that was fake news. That was a bunch of bunk. That's not true. VA loans, as well as FHA, are not handled by those agencies on the front end during origination, underwriting, and closing. That's handled directly by lenders. So we had no slowdown with VA loan processing and closings during the shutdown. That is not true, and it has not been true for a very long time. So any of those news articles that suggested otherwise, again, were fake news. So let's go to the next slide. Realtor and lender education gaps. That does exist. Many real estate agents and even some loan officers, some people in the mortgage industry, aren't fully trained in the VA process, in entitlement rules, and the assumability benefits. And so this lack of confidence leads to under promotion of VA loans when the buyer is first consulted about their loan options. If folks don't understand the process, they're going to be less confident in recommending this product type to those potential buyers. And again, that's a shame, and that's part of what has caused underutilization of this product. Next slide. We've got here market and competitive factors. In competitive markets, sellers and listing agents sometimes favor conventional buyers, especially if they've got cash offers or appraisal gap waivers. Veterans may get the impression their VA loan makes their offer weaker, which isn't true if properly presented. And when rates are lower, some veterans will refinance out of their VA loan to a conventional loan to remove the funding fee or for equity access. Yes, that's true. That does contribute to the lack of awareness of the product, and it's unfortunate. So let's go to the next slide, and I'll show you what is the bottom line if you're a realtor. Low utilization isn't due to lack of value. This is a very valuable product. It's due to lack of understanding and confidence among borrowers and industry professionals. Educating realtors, which is, of course, what I'm trying to do here, as well as the general public, educating realtors to become VA friendly helps bridge that gap and making a huge difference in how many veterans actually benefit from the program. Wouldn't it be in all of our best interest to help these veterans who served our country and some who have fallen, help them and their families take advantage of this incredibly good benefit that is underutilized? I would like to see all of us commit to helping these people who have served us so well to take advantage of this underutilized benefit. So let me go on now with the next slide, and I'm going to go into a little bit more detail about 6 features that realtors and you as potential borrowers or homeowners should know about the VA home loan program. Of course, the most obvious one, the one that the program is most, well known for to the extent it's known, no down payment required. And by the way, that's true whether you're a first-time home buyer or not. You don't have to be a first-time home buyer to get a VA loan with no down payment. Up to 100% financing is available, subject to how much entitlement you have. That's a major competitive advantage for buyers. Now, in some counties, that maximum loan amount with no down payment is limited depending on the county. And in many counties, for example, 806-500, the current conforming limit, is also the maximum VA loan limit with no down payment. But in some other counties, and by the way, even here in Riverside County, out here in the Palm Springs and greater Coachella Valley area where I'm at, while many lenders will tell you 806-500 is the max with no down payment, I actually have a lender who will fund up to $2 million of a VA loan with no down payment, even in Riverside County. Now, obviously, you have to make quite a bit of money per month to qualify for that loan, but nonetheless, it is available. And again, a lot of folks don't realize that. One other thing you can see in the bottom of this slide, guess what? There is no maximum VA loan amount. The agency doesn't set a maximum loan amount. That's up to lenders, not to the agency. So you can see sometimes multi-million-dollar VA loan amounts in some markets because the VA doesn't establish a limit. That's all about lenders establishing their own limits, which we often call in the industry overlays. So if there is a maximum limit you're being told, that's coming from the lender, not from the agency. The next feature, there's no mortgage insurance on VA loans. Of course, mortgage insurance is the proper term if you're talking about a government insured or guarantee loan. We all kind of generically call mortgage insurance PMI. That's private mortgage insurance, which the distinction there is PMI is mortgage insurance on non-insured, non-guaranteed federal loans. So the idea, though, is with VA loan, there's no mortgage insurance at all. They don't have it. So you're not paying a monthly mortgage insurance payment when you're getting a VA loan. Instead, what does the VA do in terms of revenue that goes to the agency? And what is the purpose of that revenue to the agency? Well, it's called a VA funding fee. The VA funding fee is a lump sum amount. If you're using your benefit for the first time, it's 2.15% of your loan amount. Now, like an FHA upfront mortgage insurance premium, which is 1.75, the VA allows their VA funding fee of 2.15 for first use to be financed into your loan amount. You're not going to pay that out of pocket as a lump sum. That way you're paying it back through your monthly principal and interest payment. Now, what happens to that 2.15% lump sum amount? When your loan closes, that amount's dispersed to the Department of Veteran Affairs. That goes into their reserves to be prepared to honor claims from lenders who have to foreclose on VA loans. Because remember, VA doesn't make loans. They guarantee loans. So the VA funding fee, also known as a guarantee fee, that is used to put into the agency to create the reserve that they tap into on occasion, when a veteran borrower unfortunately is foreclosed on, now that lender can submit a claim to VA and get reimbursed for the loss. That's what the VA funding fee is all about. That's what it's for. So it's not income to the lender. So don't think that goes to the agency. And by the way, if you've been in service, you're out of service now, but you're a qualified veteran. If you have a service-connected disability, you could potentially have this funding fee waived entirely. And that can be true even if your disability level is not full disability, because in the veteran situation, you can have partial disability, and it goes in percentages. And depending on your percentage amount, you could be eligible to have this VA funding fee waived entirely. So that is an added great benefit for those who are still able to, have a job, be employed, but they have a service-connected disability. You get that added benefit of VA not charging you that funding fee. That's another way that the VA basically honors your service and helps you achieve home ownership. Another feature on the next slide, more flexible credit and underwriting guidelines. VA loans are much more forgiving in terms of getting you qualified, more forgiving on credit, more forgiving on debt to income ratio and past financial challenges, and that makes home ownership more accessible. For example, VA doesn't have a minimum credit score level. Now lenders do. So lenders will have a minimum credit score of 500. And yes, there are lenders, and I have access to some, who will make a VA loan down to a 500 score. That's much, much lower than a conforming Fannie and Freddie loan. VA is much more forgiving on past, what we call derogatory events. For a VA loan, you only have to have 2 years of seasoning since you've had a previous bankruptcy discharge, only 2 years. That's a much shorter period than if you're going to get a conventional loan. And VA does not have a debt to income ratio maximum. They have no maximum whatsoever. I've actually closed VA loans where the debt ratio is in the mid 60s. How is that possible? Well, VA doesn't focus on debt ratio. They focus on residual income. So if your loan application meets VA residual income guidelines based on your family size, you can get your loan approved even if your debt ratio is 67%. And I've done one of those, so I know that to be true. Again, another great feature of VA loans that realtors need to know about, particularly if you've got a buyer who is credit score challenged or debt ratio challenged. The VA loan is a great option, can help that buyer get that financing and get that home purchased. As a realtor, you need to know that, and don't push aside the VA as an option, because it can make a big difference for some of your buyers. Another feature on the next slide is that competitive interest rates. VA rates are often lower than conventional. It says are often lower. I should have crossed that out and said are lower, because that's virtually always the case. A VA loan is going to offer a better rate than a conventional loan, in particular if you are more challenged on credit score. I mentioned before, if you're going to get a Fannie Mae, Freddie Mac loan and you've got a credit score that's closer to that 620 minimum that Fannie and Freddie have typically required, you're going to pay dearly in terms of a higher rate. Fannie Mae and Freddie Mac are very, very aggressive in price, what we call price adjustment factors for lower credit scores. VA is not true. As I show in the bottom there, an example. If you want an $806,500 loan amount with no down payment and your credit score is a 660, I can get you a 5.5% 30-year fix with no points. If that was a conventional loan at 660 with no down payment, of course, conventionals don't allow no down payment. You have to put at least 3% down if you're a first-time home buyer. You'd be looking at a rate in the sevens, low sevens. But if you're a veteran borrower, 5.5. That is a terrific feature that, again, is underutilized and not well understood. Next slide is yet another feature. Now, and this is probably the most controversial part of VA loans and where there is some resistance. Yes, VA appraisals do have to meet what we call minimum property requirements. The idea here is the VA wants to make sure that a veteran borrower, when they acquire their home through VA financing, that they're going to get a home that at least meets basic health and safety standards, livability standards. So yes, it is possible that on a VA transaction where the appraisal is done, There may be some work requirements required by the appraiser that would have to be done before closing. But these, again, are focused on health and safety issues, livability issues. And so, yeah, in some cases, if you've got a property that's in very poor condition, a fixer, as we call it, yeah, you may be subjected to some repair requirements. But consider it this way. If you're a realtor and you're about to take a listing, if you've got a property that's in very good condition that you are confident that is going to pass any inspections as it relates to health and safety issues, livability issues, you darn well should consider ways to market that program to veteran buyers, because they can get great terms. You're going to have a greater range or market of buyers because of the more flexible underwriting guidelines. It just, you owe it to your seller to make that particular home available to this particular buyer profile, because again, we need to educate sellers. VA buyers usually are very strong. They're qualified borrowers in most cases because the guidelines are more flexible. Yes, the appraisal process slightly more structured, but I think in a lot of cases, maybe most cases, not so much more structured that you should steer people away from this particular product type. The last thing I'll say about this, to know, particularly realtors, as well as if you're a seller to sell a home, yes, you have to get a termite report. That's required on all VA transactions. And yes, if you have Section 1 or Section 2 repair requirements, they will have to be done. But again, consider that when you're first listing the property. If you're confident that property is in good condition, has minimal to no termite issues, then that property should be made available to veteran borrowers. You should have no worries about that termite report if you already know the property is in very good condition. So next slide. On this one, want to know, this is one that, again, is not very well known. The VA loan benefit is reusable. A lot of veteran borrowers think that you can only use the benefit one time. Not true. If you've used a VA loan in the past, if you've sold the home and that loan was paid off when you sold it, you can get your entitlement restored in full. So you can use it again. Now, if you use it again, your VA funding fee goes up the second time. It's 3% rather than 2.15. But still, that is not a reason to dismiss VA as an option for your second purchase. If you've gotten rid of that first home and you paid off that previous VA loan, you can get your entitlement fully restored. The other thing is, you can sometimes, let's say you have a case where you bought a home 20 years ago. You used your VA entitlement, which of course back then, the entitlement amount, which means your maximum loan amount with no down payment, was lower. You can, let's say you bought that home 20 years ago, you got your VA loan and you kept it. You turned it into a rental. And here you are 20 years later, and you want to buy another home and you want to use your VA loan again. You can, based on partial entitlement. There's a formula. We can do this for you, where we would figure out what the entitlement was done at the time you bought that home previously 20 years ago, do the math to figure out how much remaining entitlement you have now, and then we take that remaining entitlement, multiply it by 4 to find out what your maximum loan amount now would be for no down payment. Now, what if the home you want to buy is at a price where that new remaining entitlement won't allow you to buy the home now with no down payment? Let's say there's a $300,000 gap between the maximum loan amount with your partial entitlement that you can finance with no down payment versus the price of the home you're looking at. Well, you don't have to make that whole $300,000 gap out of pocket. You only have to put down 25% of that. So, for example, on a $900,000 purchase price, and we've determined you have partial entitlement that allows you to finance a home with no down payment today for $600,000. Well, you don't have to pay $300,000 down payment to cover the difference. You only have to pay 1/4 of that, $75,000. So you can buy that $900,000 home with an $825,000 VA loan at 5.5%, even if you have some of your entitlement used from a previous home from 20 years ago. Again, it all depends on the math. We can help you with that and help you realize that you can still use it again in that scenario. And the other thing I want to point out, VA loans are assumable, even if the new buyer is not a veteran. So did you buy a home in 2020, 2021, use your VA entitlement? You got a rate at 2.5%. Here we are in 2025. You didn't think you'd want to move or sell your house because you have such a low rate, but let's say you've got a job relocation. So you're going to be forced to move. And you're going to go ahead and sell your home as part of that move. Well, you can now market your home with a loan that's assumable with a 2.5% rate. Now understand, and again, the buyer who would assume that does not have to be a veteran. Now, if they're not a veteran, where they would replace or use their entitlement to assume your loan so that your entitlement's freed up, if they're a non-veteran assuming your loan, yes, that will still tie up the entitlement you used 5 years ago. But again, as I said earlier, you may still have some remaining entitlement that you could use for that next purchase. Again, we can help you decipher if that's going to be the case or not. So again, another great feature of the VA Home Loan Program, they are assumable even to non-veteran borrowers. So keep that in mind. It can come in handy in some circumstances. So now with the next slide, I'm going to cover what probably is still the biggest misconception about VA loans, and that is the concept of non-allowable closing costs. Yes, it's true. Years ago, the VA had a specific list of closing costs that were not allowed to be paid by the veteran borrower. Again, it was an attempt to protect that veteran borrower and limit the fees that they were going to be charged. So what that meant is that there were certain, these older guidelines meant that certain lender and third-party fees could not be charged to the borrower. Well, guess what, folks? That's gone. That is old news. That's not how it works anymore. However, what's happened is we still have this perception that, oh my gosh, I'm listing a home for this seller, and they've told me they don't want to consider VA offers because they don't want to be stuck with paying fees that the veteran borrower is not allowed to pay. Not true, folks. That's outdated thinking. That's not how it works anymore. The modern VA rules have basically eliminated that strict separation of allowable and non-allowable fees. So on the next screen, let me show you what I mean by that. Here's how it works now. The 1% rule still exists, but in a different way. Now, here's how it works. The VA will allow a lender to charge either a flat 1% origination fee when they originate the loan or itemized charges for actual costs, but not both. Well, what does that mean? That's kind of confusing, right? Well, first of all, I'll tell you, most VA loans today, there's no origination fee being charged of 1%. That kind of, again, goes back to when the program was first created decades ago, when, it was more typical that we would arrange a VA loan. The borrower would get charged at 1% origination fee, which was income to the mortgage originator. That's not really how it works anymore. Every VA loan we do, there's no origination fee to the veteran borrower. It's zero. There's no points to the veteran borrower. It's zero. That earlier slide when I said a 5.5% rate available for a 660 credit score borrower, that was a rate available with no origination fee, no discount points, no points. So how does that play into the idea that non-allowable closing costs are no longer an issue? Well, because now when there's no origination fee being charged to the borrower on their loan, the VA, I should say, will allow the veteran to pay what used to be considered non-allowable costs as long as all of them combined do not exceed more than 1% of your requested loan amount. So voila, that basically means the non-allowable concept is gone. You don't have to worry about that anymore. So if you encounter any seller who starts talking about do not consider VA offers because I don't want to be stuck with the VA borrower's fees, please correct them. Please educate them. Let them know that's not true anymore. The veteran borrower can and will pay all their own fees, including things like the escrow fee, which is probably one of the biggest non-allowables historically that was always an issue with transactions. That's not the case anymore. The veteran borrower can pay their own escrow fee, again, as long as it doesn't exceed 1% of the loan amount they requested. So please keep that in mind. And then lastly, we're going to finish up with the last feature of the VA Home Loan Program that y'all need to be aware of, 4% seller concession limit. So yes, a seller can provide a concession to the borrower, the VA borrower, in dollars, up to 4% of the sales price. And by the way, that 4% concession amount excludes typical closing costs. So as a consequence, this 4% concession can be very, very helpful and very powerful in providing that borrower some benefits to their financing. You ever heard of the concept of VA no-no? Well, what that entails is you have a situation where a seller sells a home to a VA borrower. Their entitlement is such they can get that house with a loan amount equal to the purchase price, so no down payment. That's the first no. And then if they negotiate the seller to give them a concession in dollars equal to their closing costs, a veteran borrower can literally buy a home, depending on their entitlement, with no down payment, no closing costs. That's where we get the VA no. They can buy a home with no money out of their pocket, essentially. Consider that. That is a tremendous opportunity for the veteran home buyer. And if you're a seller, you've got a property in good condition. You're not worried about getting beat up on repair items. You got a property that is going to be fine in terms of a termite report. Have you ever considered maybe setting your list price in such a way that you're willing to provide up to this 4% concession and then market your property to veteran borrowers, to veteran buyers, potentially offering them a VA no opportunity? I got to tell you, I can't imagine why that wouldn't generate some interest for your listing and maybe help you sell your listing faster. So consider that. Again, realtors, you should keep that in mind. If you're a veteran borrower considering going out there to look for a home to buy, I'm hoping that all of this information that I'm giving you today will help you to be better informed and more educated as to why this particular benefit is a terrific option to consider and why it should be, and I'm hoping in the future will be utilized in a much greater way. So that really concludes my presentation about VA home lending. If I can help you in any way with your consideration of a VA loan to buy a home, or if you're an owner of a home, you're getting ready to sell it, you want to know more about how you can include a VA loan option to prospective buyers and what that would be as to an impact to you as a seller. If you're the seller or if you're a listing agent of the seller, please call me. My information's on the screen there. Call me, send me a text, send me an email. I'll be happy to go over these details with you in more, further. And if need be, I'm happy to give you some numbers, worksheets to illustrate some of the potential scenarios that we can use to more successfully get your home sold quickly. And most importantly, to those who have served our country and help them take advantage of this great benefit. So with that concludes today's Mortgage Minute. I want to thank you for watching and listening to this edition of the Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Have a great weekend. I understand it's be kind of rainy here in California, but anyway, enjoy that cup of coffee and watch the raindrops, and we'll see you next week on the next edition of the Mortgage Minute. So long. Take care.